Hey everyone, welcome to Borrow, Buy, Build. And today we're stepping up to the plate, literally, for one of the biggest games of your life. That's buying a home. Now I know what you're thinking. Mortgages, paperwork, the nomenclature. It can all feel like you're facing Mariano with a full count at the bottom of the ninth. But what if I told you that getting a mortgage is a lot like playing the game of baseball? That's right. We're going to break down my entire home buying process using a mortgage in a four simple basis. And by the time we're done, you'll be rounding those bases like Rose and sliding into home plate head first, smelling like one too, so that you can feel confident about getting the keys to your brand new home. So lace up those cleats because the game's about to begin. And by now, we've already introduced you to some of the great programs available, all backed by great coaching before you even step into the batter's box. So the first stop, first base, is the credit check. And it's all about getting you on base and proving you've got what it takes to play in the major leagues of home ownership. So that first base, running your credit, stepping up to the plate, is what we're talking about right now. All right, team, so you're up at the plate, bat in hand, and we're looking down to first base, the credit check. And just like a baseball scout looks at a player's stats before drafting them, lenders look at your credit report and score to see if you're a good candidate for a loan. Think of your credit score as your batting average. The higher it is, the better your chances of hitting a home run with a great mortgage rate. So, what exactly are lenders looking for in this scouting report? They're checking your credit history. It's like your career stats. Do you pay your bills on time? And how much debt are you carrying? Do you have any strikeouts like bankruptcies or foreclosures? Lenders want to see a consistent record of responsible borrowing. Most conventional loans are looking for a batting average or a credit score of at least 620. But to really knock it out of the park and to get those prime interest rates, you'll want to aim of a score of 780 or higher. Don't worry if your score isn't perfect. Some programs can work with scores as low as 620, but you might face a tougher pitcher and have a higher interest rate. Now, you might be worried that checking your credit too often will hurt your score. It's like taking too many practice swings and tiring yourself out. But here's a pro tip. When you're shopping for a mortgage, multiple credit checks from different lenders within a 45-day window are usually treated as a single at-bat or inquiry. So shop around. It's like getting a few different pitches to look at before you swing. This won't significantly drop your batting average. However, try to avoid applying for other types of credit, like new credit cards or auto loans, right before or during the mortgage process. That's like trying to play two different sports at once and throw off your game. What happens during this credit check? The lender will pull your credit report from all the major credit bureaus, and this report will show your borrowing history, any outstanding debts, and any public records. They'll verify your identity and look at your residence history for the past 2 years. It's like an ump checking your number before you step up to the plate. Now, a hard inquiry could appear on your report, but that shouldn't be any big deal. That's a normal part of the game when you're seriously looking to buy. So, what's the takeaway for first base? Know your stats. Check your credit report before you start shopping for a mortgage. And the best part, you don't have to commit to a full application and pay a fee for your credit check. You can easily get a free copy from annualcreditreport.com. And this tip of the trade is one of my best because you can spot any errors, like a foul ball that's clearly fair, and dispute them. Getting those corrected can boost your batting average and put you in a much stronger position. Link in the description below if you're interested on how to mop up errors. Making it to first base means you've shown lenders you're ready to play Moneyball. Your credit's solid, and you're ready for the next challenge. Second base, documenting your financial. You're proving your stats to the team. Welcome back to the diamond. You've made it to first base by showing your credit's in good shape. But now, Coach Lasorda, that's your lender, wants to see you're more than just sort of interested by reviewing your stat sheet. This is second base, documenting your financials. And you have to think of this as proving you're not just a one-hit wonder, but a consistent hitter who can deliver when it counts. Just like a major league team won't sign a player without them passing a physical, your lender needs to verify that you have the income and the assets to handle your mortgage payments month after month, year after year. This isn't just about having a good game every once in a while. They want to see that you're fully capable and you can perform under pressure. So what documents do you need to bring to the coach's office? Most important, your income verification. It's like showing your RBI stats. It proves you can drive in runs, or in this case, make those monthly mortgage payments. You'll typically need 1 month's worth of pay stubs. This shows your most recent earnings and proves you're still active and on the team. Think of it as your latest stats. Now, have 2 years worth of W-2s and tax returns ready. This is your career batting average, and it shows consistency over time. Lenders want to see that you haven't had just one good season, but that you're a reliable player year after year. If you're self employed, you're like a great free agent. You'll need to provide even more documentation of your proper value. That means more than just tax returns, profit and loss, balance sheet statements, and some additional documentation may be required. Free agents always have to work a little harder to prove they're worth the investment. But income isn't everything. The coach also wants to see your financial reserves. That's where your bank statements come in. You'll need 2 months worth of statements for all your accounts. Think of this as showing your signing bonus is real and that you've got money in the bank for a rainy day. Lenders want to see that you have enough, not just saved for your down payment, but also the closing cost, in addition to a few months of mortgage payments as a safety net. If you plan on using business funds for a personal mortgage, the lender may want to document that this will not upset your cash flow. It may require more than just a few months, it may also require some help from your CPA. Now, here's where the baseball analogy really hits home: your debt to income ratio, or DTI. This is like your on base percentage. It shows how efficiently you handle your financial at bats. Most lenders want to see a back end DTI of 36% or lower on conventional loans, which means your total monthly debt payments, including your new mortgage, shouldn't exceed 36% of your gross monthly income. If your DTI is too high, it's like having a low on base percentage. You might still make the team, but you could face tougher terms. Employment verification is another crucial play. The lender will contact your employer to confirm that you're still on the roster and verify your position and salary. They want to make sure you haven't been traded or released. You'll need to provide 2 years worth of employment history. And if you've changed jobs recently, don't panic. Job changes can actually be positive if they show career advancement. That's like getting called up from the minors to the majors. Now, let's talk about your residential history. Like employment, lenders need 2 years worth of addresses to document where you've lived. This isn't just paperwork, they're checking your stability. Don't worry if you've moved for legitimate reasons like job relocations or family situations. Just be prepared to explain your moves like a player explaining their career path. Here's a pro tip that many first-time home buyers don't know. If you're getting gift money from your family for your down payment, that's totally allowed. Think of it as getting support from your home team fans. However, you'll need a gift letter from the person giving you the money, stating that it's truly a gift, not a loan that needs to be repaid. Depending on when the gift comes into pinch hit, your lender may also want to see the donor's source of funds to verify they have the capital to gift. It's like proving the fan actually bought the ticket to support you. Asset verification goes beyond just checking accounts. If you have investments, retirement accounts, or other assets, these can strengthen your financial position. It's like having multiple skills as a player. Maybe you can pitch and hit, making you more valuable to the team. However, some assets are easier to count than others. Money in savings and checking is like cash in your wallet. It's immediately available. Retirement accounts might be counted differently since there are penalties for early withdrawal. One thing that trips up many players at second base is timing. Don't make any financial moves during this process. Avoid opening new credit accounts, making large purchases that deplete your assets, or moving money between accounts without telling your lender first. It's like changing your batting stance right before the playoffs. If you need to make money moves or make a large purchase, talk to your lender first. They can advise you on the best way to handle it without it impacting your loan approval. The lender will also calculate your reserves. That's the money you'll have left over after closing. Think of reserves as your bench strength. Even after you pay your down payment and your closing costs, lenders like to see that you have some money left over, typically 2 months, but it could be more depending on how much you're planning to borrow. This shows you can handle unexpected expenses, like a player who can adapt and show you have the ability to play from behind. If you're buying a condo or a property with a homeowners association due, these monthly costs will be factored into your DTI calculation. It's like playing in a league with some additional rules that you need to account for the entire game. And the same goes for property taxes and homeowners insurance. These aren't optional extras, they're part of the game. For those who are self employed or have irregular income, second base can be more challenging. But it's not impossible. Lenders may look at you like a freak, unique, but effective, like Tim Leroy Lincecum. It may take an extra at bat or two, but keep your eye on the ball. You may need to provide additional documentation like business licenses, contacts, or even reference letters. The key is showing consistent income over time, even if it does vary month to month. Here's what success at second base looks like. Your lenders verified your income, confirmed your employment, reviewed your assets, and calculated your debt to income ratio. They've seen that you're not just a flash in the pan, but a solid, consistent player who can handle the financial responsibilities of home ownership. You've proven you have both the income to make the payments and the assets to handle the upfront cost. The coach is impressed with your stats. You're ready to take a lead off second base. But remember, this is where many deals can get delayed. If there are any questions about your documentation or if you need to provide additional paperwork, please respond quickly. Think of you have to think of this as like the coach asking you for clarification on the play. The faster you respond, the sooner the game can continue. Next up, third base, underwriting the full deal with appraisal and title. This is where the league office reviews everything to make sure both you and the property meet all the major league standards. It's the most comprehensive review of the entire process. So make sure you've subscribed because you don't want to miss it. Third base, underwriting with appraisal and title. This is like the championship review. Welcome back, future homeowners. You've made it to third base. You're just 90 feet away from home. But this is where things get serious. This is the underwriting phase, which I like to think of as the videotape review. You're so close to victory you can taste it, but now the umpire, that's your underwriter, is conducting the most thorough review of your entire game. Think of the underwriter as that ump. They want to see you play the game fair and in the World Series of home ownership. They're not just looking at your individual performance anymore. They're reviewing everything, your stats, the stadium you want to play in, and whether this entire deal meets major league standards. This is the most comprehensive and sometimes nerve-wracking part of the process. But understanding what happens here will help you stay confident as you round third base. The underwriting process typically has 5 major plays, and each one is crucial to your success. Let's break them down like we're analyzing game film. Starting from play 1, the final stats review. First, the underwriter conducts what I call the final review. They're taking everything that you provided from second base and verifying it one last time. Think of it as the league office double checking that all your career stats are accurate before that championship game. They might request an updated pay stub or request a complete activity print from your bank to ensure that nothing's changed since you first applied. This isn't because they don't trust you. It's because they want to make sure that everything's updated for the end investor, that it registers on that final box score. The underwriter will also verify your employment one final time. They might call your employer again to confirm that you're still on the roster and that you haven't been traded or released. If you've changed jobs during the process, don't panic. Just like a player getting called up to a better team, job changes can be positive if they represent career advancement. However, if you've been let go or if you've taken a pay cut, that's like being sent down to the minors. It might affect your loan approval. Here's a crucial timeout. During underwriting, avoid making any major financial moves. Don't change jobs. Don't deposit large amounts of cash without explanation. And definitely don't open new credit accounts. Think of it as maintaining your form during the playoffs. This isn't the time to experiment with new techniques. Any changes to your financial situation could delay your closing or even result in a loan denial. That's like getting tagged for taking too big of a lead off base. Play 2, the property appraisal. It's like the stadium inspection. Play 2 is the property appraisal, and it's like a comprehensive review of the property. The league won't let you play in a facility that isn't safe or that doesn't meet major league standards. And your lender won't lend you money if they can't justify the purchase price. The appraiser, think of them as the independent stadium inspector, will visit the property, evaluate its condition, its size, its feature, and its overall value. The appraiser compares your home to others recently sold in the area with similar square footage, layouts, and amenities. It's like comparing your stadium to the other ballparks in the league. They're looking at everything: the condition of the roof, the foundation, electrical, plumbing, making sure that everything's up to code. And just like a stadium needs good parking and access for your fans, your home's location and surrounding area matter too. And here's what you're hoping for: an appraisal that comes in at or above the purchase price. That's like your inspector giving your stadium a perfect score. You're cleared for opening day. Now, what happens if the appraisal comes in low? Don't worry, you have options, just like a team whose stadium needs improvements. Option one: renegotiate the price with the seller to match the appraised value. It's like convincing the stadium owner to lower the rent because the facilities aren't quite the premium as originally thought. Call for a meeting on the mound and ask the sellers to work with you, armed with documentation, of course. Or option two: pay the difference between the appraised value and the purchase price out of your own pocket. We know you're not an owner yet, but here's where you want to think like one. There are always exceptions to consider, and perhaps this home is worth going above the salary cap. If you have the capital and a desire to invest in your new digs, then play ball. Option three: walk away from the deal and find a different property. Sometimes the best play is to find a different stadium that better fits your budget and your needs. Your earnest money should be protected if the appraisal comes in low, assuming you included an appraisal contingency in your offer. Here's some good news. If you're putting down 20% or more on a conventional loan, you might be eligible for an appraisal waiver. This is like being such a well-known, reliable team that the league trusts you to play in any stadium without a full inspection. It can easily save you a few $100s, perhaps between $400 and $600, and speed up the process significantly. Starting in 2025, the requirements for appraisal waivers are becoming more flexible, requiring as little as 3 to 10% down payment on some transactions. Play three: title search and insurance. It's like verifying clean ownership. This part doesn't require input on your behalf, but understand behind the scenes your title search and insurance process. It's like the league office verifying the team actually owns the stadium and has the legal right for you to play there. A title company will research the property's entire history, looking for any legal issues that could affect your ownership. They're searching for liens, which are like outstanding debts against the property. Imagine discovering that the previous stadium owner still owes money to contractors who built the concession stands, and that debt could become your problem if it's not resolved before you take ownership. Title search also reveals solar leases or even more serious easements, which give other parties rights to your property, like a utility company having the right of way to maintain power lines. The title company also checks for any pending legal action against the property, any unpaid property taxes, or restrictive covenants that might limit how you use your home. It's like making sure there's no league rules or local ordinances that could prevent you from playing the way you want to play. If any issues are discovered during the title search, just like the appraisal, you have options. You can ask the seller to resolve these issues before closing. It's like asking the prior team to clean up any outstanding stadium debts. You can request that the seller compensate you to handle the issues after closing, or you can decide the problems are too significant and walk away from the deal. Title insurance is your protection policy. Now, there are typically two policies: one that protects the lender, this is always required, and one that protects you as the homeowner. This is optional. Think of it as insurance that guarantees you actually own your stadium and that you can play there without interference. The lender's policy protects their investment, while the owner's policy protects yours. Now, play four. This is where the underwriter makes their final decision. They've reviewed your financial stats, examined your stadium inspection report, verified clean ownership, and the homeowner's insurance to back the deal. Now, they're ready to make the call that determines whether you advance to home plate or have to try again. Here, there are four possible outcomes, and understanding each will help you stay prepared. Number one is the clear to close. This is what we're all hoping for. It's the umpire saying, play ball. You've met all the requirements. You've cleared to advance the home plate for closing. Congratulations, you're about to become a homeowner. Next, Subject to or a conditional approval means you're approved, but there's still a few requirements to meet. Think of it as the ump saying, you can play ball, but first you need to fix the lighting in the stadium. Common conditions might include a recent deposit in your bank account or provided an updated pay stub. These conditions are usually minor league and easily resolved. Suspended, that means your file is missing some crucial information. It's like the game being delayed due to missing paperwork. This might happen if processing can't verify your employment, or if it needs additional documentation, or requires some clarification on something else in your file. The good news is that suspended doesn't mean denied. You can usually reactivate your application by providing the missing information. Last is loan decline. That's the outcome that nobody wants, but it's not the end of the world. Think of it as being sent to play for the Bad News Bears. Disappointing, but you can still work on your skills and try again. The lender must provide a specific reason for the denial in writing. Some of the issues can be addressed with another lender or another team, essentially. Other issues may be completely out of your hands, like the property appraisal. Understanding the reason helps you understand where you can take your game. If you've received final approval or the conditional approval, it's time for play 5, final prep for the home plate. Now pay attention to the base coach for the final signs. You'll need to finalize your homeowner's insurance, your policy effective date, and provide the contact information so your lender can verify the coverage. You'll also need to decide on your title vesting. That's how you want to hold ownership to the property. If you're married, you might choose joint tenancy or within a revocable trust. Your escrow officer or attorney, not your lender, can explain the pros and cons of each option based on your situation. This is also when you'll receive the closing disclosure. Think of it as your final game stats and contract terms all laid out clearly. You'll have at least 3 business days to review this document before closing, and don't rush through it. Getting to this stage can take anywhere from a couple of days to a few weeks, but that all depends on your file specifics, the product, and the property characteristics. Now, this might feel like the 7th inning stretch, but don't go to sleep on your loan officer. They're like your team manager, keeping you updated on the process and letting you know if the underwriter needs any additional information. Respond quickly to any last minute request and think of it as being ready to pinch hit when the manager calls your number. So, you're 90 feet from home. The underwriter has given you the thumbs up, the property's passed inspection, and you have clear title. You're ready for the final sprint home, signing and funding. Think of this final exercise, but you still have to execute it perfectly. Your family's cheering, the cameras are rolling, and you're about to hold up that championship trophy, your house keys. But let's take that final time out and break down exactly what happens during this final sprint to home plate. Before you can get on the board, you need to make sure that you have all your equipment ready. That's your closing costs and your down payment. Within the last few days of your close date, your attorney or your escrow officer will give you the final dollar amount you need to bring to the closing table. Think of this as your batting coach telling you exactly what gear you need for the big game. You'll typically need to bring these funds via a cashier's check or a wire transfer that's sent directly to the escrow company. Personal checks, they're usually not accepted, especially for large amounts because they take time to clear, and trust me, nobody wants to delay the champagne. If you're wiring the money, this is where you need to be a little cautious about where you're wiring because wire fraud's a real thing. It's like overthrowing that pitch home. 3 business days before closing, you'll receive a closing disclosure. Think of this as your final game stats and your contract terms laid out in a simple format. It's a 5-page document that looks like the official scorecard showing you exactly what you're paying for and what you're receiving. And by law, lenders need to provide this at least 3 days before you can close, so it gives you ample time to review and ask questions. Please pay close attention to these several key areas. First, that the loan amount, your interest rate, and your terms match what you agreed to. Check for any prepayment penalties, which could be like a contract clause penalizing you for paying off your mortgage early. Review your earnest money deposits and any seller or lender credits if applicable. Finally, confirm the monthly payment amount and make sure you understand what's included. Is it principal and interest, or is it principal, interest, taxes, and insurance? Closing day is your championship day. You might sign your loan paperwork electronically with the recordables with a notary or an escrow title company, or maybe even an attorney's office. And that'll all depend on your state's requirements. If you're doing the full paper close, you'll be signing a lot of documents, at least several dozen pages worth. Don't worry, you don't need to know exactly what's in there, but do ask questions along the way. The main documents include your promissory note, which is your promise to repay the loan. Next, your deed of trust or mortgage, which gives the lender a security interest in the property. Then the final CD and settlement statement. The promissory note is like your player contract. It spells out the terms of your agreement between you and the lender. The deed of trust, that's like the league's security that you're going to follow the rules. If you don't make your payments, they have the right to foreclose, just like the league can suspend a player who doesn't follow the rules. Once all the paperwork's signed, then the magic happens. The mortgage funds are sent to the escrow company, and everyone involved in the transaction gets paid for their services. The title company officially transfers ownership from the seller to you, recording the new deed at the local recorder's office. And then, the moment you've all been waiting for, you're officially a homeowner. Take a moment to celebrate what you've accomplished. You've successfully navigated the credit check at first base, proven your financial strength at second base, passed the comprehensive review at third base, and crossed home plate to become a homeowner. You've joined the ranks of millions of Americans who've achieved the dream of home ownership. The journey required patience, preparation, and persistence. You've gathered all the documents, answered all the questions, waited for approvals, and stayed focused on your goal even when the process seemed a little overwhelming. You've demonstrated financial responsibility, and it's something to be proud of. Remember, buying a home is one of the biggest financial decisions you'll ever make, but it doesn't have to be scary or overwhelming. With the right prep and coach by your side, you can confidently navigate each base and achieve your field of homeownership dreams. Welcome to the major leagues, homeowner. Let's play ball.